ULTY just dropped its first dividend after the massive one for 10 reverse split, and it's a monster, 59 cents per share. No rock, just pure income. But behind that headline is a question investors have to ask. Is this a real turning point, or is YieldMax just putting fresh paint on a sinking ship? Today, we're breaking down the split, the payout, the updated holdings, and whether this is a genuine evolution or the same old decay wrapped in a higher share price. On December 1st, 2025, the fund executed a 1 for 10 reverse split. So if you were holding 430 shares, you're now holding 43 shares. Your total market value didn't change at all, but the optics did. Overnight, the fund went from hovering around $4 to trading near 39. This is classic damage control. Reverse splits are what companies use when they want to avoid looking like a penny stock, avoid delisting pressure, and reset the scoreboard without actually solving the structural issues underneath. Then, on December 2nd, the fund announced its first post-split distribution, 59 cents per share. And just to be clear, this is fully split adjusted. It's not a bigger payout. It's simply the previous distribution multiplied by 10. From an investor standpoint, your income didn't shrink. That's the good news, and hopefully that consistency continues going forward. But the more important detail is this: the distribution came in at 0% ROC, and for YieldMax, that's rare. Zero ROC means the fund generated real income, options premiums were elevated, volatility returned, and the ETF didn't have to dig into its own NAV just to make the payout. Weekly, that works out to roughly 1.48%, or about 77% on an annualized basis. The question now is whether this is a genuine shift or simply a one-week showcase to make things look cleaner before slipping back into the old pattern. YieldMax made one of the biggest strategic pivots we've seen from them so far. ULTY's entire holdings philosophy went through a reset. The fund shifted from what was essentially a meme and moonshot basket, a collection of speculative, high beta names, into something far more intentional. Before the overhaul, the fund was leaning heavily on stocks like MicroStrategy, Upstart, Rocket Lab, and AST Space Mobile. These companies had sky-high implied volatility, sometimes over 100%, but they also carried the constant risk of catastrophic drawdowns. It was volatility, sure, just not the kind that rewards long-term investors. Today, that basket looks very different. YieldMax has replaced the lottery ticket names with what I'd call big boy volatility. The new lineup centers around mega-cap tech, AI infrastructure, and institutional-grade crypto exposure. That includes Meta, Broadcom, Alphabet, Palantir, and Quanta Services, paired with crypto-linked positions like the iShares Bitcoin Trust, Robinhood, and Circle. And the shift hasn't stopped there. Additions like Nvidia and Salesforce in late November help round out the portfolio with companies that generate consistent option premiums without the same blow-up risk. It's part of YieldMax's broader effort to stabilize the fund after months of pressure from investors questioning the NAV erosion, shrinking payouts, and the steady flow of money leaving for more predictable income ETFs. Their new approach is clear: shift away from hype-driven volatility and instead pull option premiums from companies with real earnings, real cash flow, and volatility that doesn't rely on retail speculation. The fund is trying to evolve. But underneath all of this progress, the long-term structural risks haven't changed. The fund is still paying out roughly 70% on an annualized basis, and that's a real issue. Option premiums can't support that forever. Volatility comes in cycles, and when it cools, those payouts naturally shrink. But we all know that YieldMax is extremely unlikely to reduce distributions, because the high payouts are the main reason investors stay in the fund. And when the fund tries to maintain those payouts anyway, that's exactly when NAV erosion creeps back in. And that's the trap with this product. When the market dips, the fund still absorbs the full downside. When the market rallies, the upside gets capped. No matter how polished the new version looks, those underlying realities remain the same. In my opinion, the reverse split cleaned up the share price, but it didn't rewrite the story. It didn't repair the deeper issues we've watched unfold over the last year. The broader NAV trend, the steady erosion we saw throughout 2024 and 2025, remains virtually unchanged, and even with the new optics, the last distribution was quietly adjusted downward, which has been the trend over multiple times in recent weeks. That alone tells you the fund is still wrestling with the same pressure points, falling premiums, inconsistent volatility, and a payout target that's simply too high. At the end of the day, ULTY is still exactly what it has always been, a high-yield, high-risk income product that demands careful evaluation from every investor. If you're in this fund, you need to understand the mechanics, and if you're considering it, you need to understand the trade-offs. The easiest way for YieldMax to fix the NAV issue with this fund is to cut down the distributions by a huge amount. They could do 20%, maybe 30%, instead of 70, 80, or more. The NAV would finally have room to breathe. Premiums wouldn't need to carry an unrealistic load, and the fund could actually start acting like a long-term product. But here's the problem. The moment they cut the payout, the fund becomes just another ETF. No headline-grabbing yield, no viral screenshots of enormous weekly income, and because so many investors are here only for the massive distributions, YieldMax knows cutting the payout would trigger outflows overnight. YieldMax gets paid based on how big the fund is. If investors run for the exits after a distribution cut, the fund shrinks, and so does YieldMax's revenue. So instead of fixing the root issue, they keep the payouts high to keep the attention coming in, even if it means the NAV keeps sinking. The irony is that the big payouts were never sustainable to begin with. Not when the NAV was getting destroyed at the pace we saw in 2024 and 2025. Those massive yields were never true long-term income. They were partly the fund returning pieces of itself to maintain the illusion. So yes, cutting the distribution would help fix the NAV problem, but doing that would expose the truth. The giant yields were never sustainable, and YieldMax can't afford the drop in fees that would come with admitting it. At the end of the day, ULTY is a fund with very real trade-offs. If you're already invested, stay honest with yourself about the risks, the NAV trend, and whether the income justifies the erosion. And if you're a new investor looking in from the outside, make sure you understand exactly what this fund is and what it isn't before you jump in. Income is great, but long-term sustainability matters even more. As for me, I'm not holding this fund. I'm choosing to watch from the sidelines and see how the strategy develops from here. If you found any value in this breakdown, go ahead and like the video, subscribe, and turn on notifications so you don't miss the next video. Thanks for watching, and I will see you in the next one.